Hello, everybody. Green Effect Podcast, Season 6, Episode 4. We got a lot of stuff to go through because there's no shortage of excitement right now in the world, in the market, mortgage world. Believe it or not, yes, mortgage world is actually exciting. But before I get into all the excitement, I want to make sure that you know I have an upcoming webinar with two fantastic folks, and we're going to be talking about how to help your kids buy a home. So if you remember from our last podcast, I was talking about baby boomers and even the older Gen X's. You got to start transferring some wealth because you know those kids in your house that just are not leaving, they might not leave for a while. So we're actually doing a session. One of my fantastic friends and partners, George Duby, he is an accountant and he is big on being really smart with taxes, but also making sure that we can generate generational wealth, right? Or create generational wealth is what I should say. So March the 12th, 7 p.m. If you are a first-time homebuyer who maybe wants to bring this back to your parents, let us know, sign up, shoot me a message, I'll get you the link. Or if you are that older Gen X or that baby boomer who's like, how do I get these damn kids out of my house? Shoot me a message, March 12th, 7 p.m. And yeah, how to help your kids buy a home. There's different ways to do it. Okay. All right. So you're going to see me look up quite a bit here because I'm just using, obviously, multiple monitors. If you see me looking up, I'm not daydreaming. I'm actually just referencing my notes. All right. So let's get right into some stuff. Oh, I've talked about this before, and private mortgages are back in the news. There was a video through CTV where there was a single mom who took out a private mortgage and now she can't get her money back. Basically, the story goes she saw on social media that you can make a lot of money off private mortgages. It's lucrative, it's amazing, it's wonderful. So she goes to her bank and she takes out a home equity line of credit. So she does a refinance for the sole purpose of taking out money for a private mortgage. Does the refinance. 150,000 goes into a private mortgage. It's lent out through a mortgage broker and one of their private funds that they have, which I'll talk about in just a moment. Anyway, the first year, she's like, fantastic. It brought in extra money. She's a single mom, had one job. Hey, it's tough to make ends meet. So first year goes really well. Second year, they stop paying the bills. Now remember, private mortgages are higher risk. That's why it's a private mortgage. They can't get approved through a traditional lender. You got to understand there are huge risks. It's not guaranteed. Lucrative, yes, higher risk. High risk, high reward. We've all heard that term before. So anyway, she's on CTV talking about, it's Pat Foran, right? That guy is all over my algorithm. But on CTV talking about the fact that she's screwed. Like, can't get her money back, right? It's going to cost her a ton of money, probably in legal fees, time, loss of interest, everything. So, I mean, I'm beating this one over the head where, listen, if you can't take the heat, don't get in the game. And I know a lot of people, I'm not naive enough to think that a lot of people were probably sold a bit of a package of goods here saying, hey, private mortgages, wonderful, amazing. You can't lose. And this is why in our industry, it's even more and more regulated. Like you got to do an actual exam to make sure that you can sell a private mortgage. So the other part too, promissory notes, those things are rearing their ugly head right now. You got to understand, folks. People think a promissory note is also just easy peasy, money goes out, get the money back. A promissory note is as good as the paper or the napkin it's written on. You may as well write it on a damn napkin. So a promissory note basically says, hey, going to give you some money. You promise to give it back to me. In fact, your promise is so good that I'm not even going to put a lien on your house or a collateral charge, as it's called, or whatever. I believe your promise. You're going to get me that money back. That's a promissory note. So we have had over the last few years now, promissory notes gone horribly wrong. When I see them lent out at 100, 200, 300,000, that's a lot of money. Secure it. If you're doing a promissory note at $5,000, 3, 2, okay, fine. Different scenario, obviously. But privates, which are normally secured, they're taking some heat. Private mortgages, promissory notes. Proceed with caution. Lucrative? Sure. High risk? Through the freaking roof. Understand this. Also understand that I think a lot of these things were sold through the boom. We can now say that, through the boom, as no loss. You will make hundreds of millions of dollars off of your $100,000 investment. It's unfortunate. I think people come, I don't think, I know this is the way it is. People come to mortgage agents and mortgage brokers, mortgage professionals, because they're supposed to know how these things work and explain pros and cons. So when that trust is completely just killed because you're not doing the right thing for your client, here's the world we end up in. And it's sad because I think a lot of people are going to have a challenge. Now, the one thing I want to talk about from earlier, I said I was going to come back to, remember that there's a couple of different types of private mortgages. There's lots of different types of private mortgages, but a key difference is there are, like this lady from the CTV article. Her type of private mortgage was offered through a private fund that was funded by a mortgage broker and their office and their fund. So they generate, you can do this as a mortgage broker or a mortgage agent where you have a fund and then you can lend out that money based on your recommendations to clients, et cetera. It's just your own little private thing. On the other side, though, there's the corporate private mortgages. And the corporate private mortgages are offered by massive corporations backed by investors, usually some additional scrutiny. So you're lending out and they've done some more due diligence. So there's some big differences in private lending. It's important to understand where is the money coming from, right? If I'm coming to you maybe as an investor, understanding where the money is going, who is the money going to, don't just give it out blindly. Understand who is getting that money, because there are those two differences. There's the corporate side and then there's the personal side, and it's important to understand both sides, right? For example, if you're doing a private mortgage through a broker, through their fund, are they using the same scrutiny that a corporate private lender is using? These are things you got to find out because it's high risk. Do your due diligence. I would even go as far as if you're going to give out money on a private mortgage or a promissory note, if you should even ever do that anymore, you better have your own lawyer. Like when they say take these docs to your lawyer and check them out, take them to the damn lawyer and make sure the lawyer reads everything. That's not something to be skipped at all. I know a lot of legal documentation is there because a lot of jargon and stuff like that, but you got to make sure you read the fine print on a private mortgage when you're lending out money like that, because it can go wrong. And here we are, it's going wrong. That's my comment on private mortgages, what we've seen lately. Okay, let me dig into some mortgage news that has come across the wire in the last couple of weeks, and then I want to get into some stats. Okay, so a couple of things happened that's really important to understand. OSFI, Office of the Superintendent of Financial Institutions, they had their annual meeting back, I believe it was January 20th, 29th. Now, why this is important, there was a lot of rumors. Are they going to eliminate the stress test, otherwise known as the qualifying rate? And let me explain what this is so you can understand why this is so important. Stress test is if you're getting a mortgage and the contract rate, that's the actual rate that you are paying, your payments are based on it, interest, etc. If you're getting a mortgage and the rate is 4.5%, and you go to get the mortgage, you have to qualify. It's not what rate you're going to pay, but you're going to qualify 2% higher, as if the mortgage was 6.5%. This started in 2017. It's arguably what could have taken a complete meltdown, okay, through 2022, 2023, and more a really bad economic situation. Because everybody who got a mortgage had to qualify as if the rates were 2% higher. Now, we all know you get your mortgage and then you go buy a car and take on debts. I mean, yeah, I get that it's not a complete protection, but you know what? It helped. So now, because there's so much slowdown in the market, which we'll talk about stats very soon, the rumor was, does OSFI, who babysits the banks, will OSFI eliminate the stress test just to be able to stimulate the market? Because you got to remember, when the real estate market just grinds to a halt, which is it's pretty darn near there, we're not just talking people ain't buying homes. We're talking everything from municipalities and governments are not collecting land transfer tax, labor issues with construction, builders don't build. I mean, I could just keep going on. But if we eliminate the stress test, can we get more people to buy homes? Now, huge rumors on this. When they met, they didn't even talk about the stress test. Wasn't even on the agenda. So the answer is no. There's no stress test elimination. I can't. There was rumor it had to happen. It didn't have to happen, right? If everybody, again, if this went from if we avoided a meltdown and went to just an economic big, huge freaking problem, I think it's a win for them. They're kind of winning. Now, what they did talk about, and this is important, OSFI talked about the loan to income ratio. Now, this first surfaced last year when they actually put it into pilot. Okay, it was a pilot program. And the thought was, okay, during the pandemic, the loan to income ratios were like in Vancouver, Toronto, 7.5 to 9.5. Let me explain what loan to income is. That is the loan amount ratio to your income. Super simple, not going any deeper than that. So, for example, if you make, pardon me, if you make 100,000, okay, as annual income, you can afford, or the most that they will, and yes, I used a calculator for this calculation because it's first thing in the morning, and I'm not all the way there yet. But anyway, if you make $100,000, the maximum loan you are allowed is $450,000, 4.5 times your income. Okay, loan to income ratio or income to loan ratio, whichever way you want to look at it. So during the pandemic, because rates were so low, people could afford a lot. Rates were 1 point nothing percent. Really, at 7.5 my income, I can afford a lot more. That makes sense, right? It makes sense. I'm not saying it was a good thing. It makes sense. But as rates creeped up and creeped up, that $100,000 didn't go very far. The max you could afford was only 4 times your salary because the rates went so high and the prices hadn't come down yet. So overall, what they decided to do, because 2023, 2024 loan to income was in line or below that kind of 4.5 magic number that they really like, last year for, let's call it calendar year 2025, they did a pilot. What are the loan to incomes on these deals that are going through? And loan to income it's not really per file. The way OSFI is monitoring and managing it is at an institutional level. Because at the end of the day, we have exceptions. Bank make exceptions. Maybe we're going to do a 6-to-1 loan to income ratio because you have $1 million in cash. Okay, mitigating factor makes sense. So there is room for the exceptions. Having said that, it's at the institutional level. So what happens is if OSFI comes down and says, hey, RBC, I need your percentage of deals you're doing over the loan to income ratio. How many are you doing over and above that? I don't know what the exact number it has to be, but that's what they're monitoring, right? So OSFI, hi, I'm Mr. RBC. 60% of our mortgages are over 4.5 times. OSFI ain't going to like that too much. So what we started to see last year, we had one lender in particular who was way over. I mean, way over institutionally. And for the first time, I actually saw it in a deal notes. They declined the mortgage because they said loan to income ratio is too high. And I'm like, yeah, because it's a specialty program. But they basically said, no, at an institutional level, we're too high. So I think this is where OSFI is going to be more involved, is the because if you really think about it, if we brought loan to income for every deal and that's it, yeah, we had to qualify in every single deal, that's going to be a challenge. But this leaves the institution with room. They can grant exceptions. And they can say, okay, today we're at like 20% of our books over LTI. We're going to pare back maybe. Or our book's only 5%. We can afford to take on more risk. That makes a little more sense. So that's what OSFI came out with. Stress test it wasn't even on the damn agenda. It was all about loan to income. So this is something that we're going to follow, because as OSFI reviews all this data, that really is going to determine what exposure our lenders have in this market. So a lot more to follow on that one. Okay, let's talk about the jobs report, because the jobs report is wild. There's so much more. Every month this job report comes out, and there's stuff that you're like, what is even going on? It's so wacky. It's not just the number, it's the stats behind the numbers. So the one thing we talked about last time around that was the biggest concern, I remember I was saying that I was at our annual mortgage conference, and Benjamin Tal, one of the foremost economists in Canada, great speaker. If you ever get a chance to talk or to listen to or talk to Benjamin Tal from CIBC, go. Just spend the money, go listen to the guy talk. So the one thing that he was the most concerned about was youth unemployment, because youth unemployment was like, I don't know, 15. It was like 20. It was a big number. I can't remember the exact number, but it was huge. And he said that's the biggest concern, because if our youth are not getting jobs, they're not getting work experience. And he said we're going to have this huge, inexperienced group going through. This is the COVID cohort. Okay. They're all going to go through without work experience. And then Canada as a whole, as the baby boomers and Gen X die off, we're going to have just a more overall inexperienced workforce in Canada, coupled with the fact that immigration is on the downward zero, is going to be a big problem for Canada in general. So anyway, just to recap, that was his biggest concern. So let's talk about what happened in the January report, keeping in mind it's now February, so we now report on the month before. So job a lot of people are like, this ain't real. Okay, so real simple, the unemployment rate dropped to 6.5%. I think it was like 6.8 or whatever it was before. It doesn't matter. But it dropped. It's like amazing. No, not amazing. So just some breakdown in statistics. So private sector employment fell like 52,000 jobs. Why is this important? We have a government right now that has, I'm sorry for anyone who works at the government, we have a bloated workforce, right? There's a lot. When the Trudeau government came through, they hired people like it was going out of style. We just have so many people, and you've already heard they've started to lay people off, right? Federal, provincial. I think the provincial government's more doing it for the return to work thing, where they're just going to turn it up until they get to 5 days a week and people just drop off. I don't know. I'm guessing at that. But when private drops, that's our small businesses. That's not good, right? If small businesses are not hiring or they're shedding jobs, that's not good for our economy in general. So that's one part. Wage growth slowed a little bit, not a lot. A lot of part-time jobs were shed as well. Also, not good. However, let's talk about the biggest part that impacts the numbers. And I'm just looking for the exact number right here. Bear with me. Here it is. So you're probably wondering, well, Stephen, all these jobs were shed. Like we're not hiring people. How did the unemployment number drop? That's a great question. Let me explain. I've been part of a labor survey before. Annoying as hell. Okay. They call you nonstop and don't even think you're going to ignore them like a telemarketer. They come at you. All right. They're like, we want answers. I'm pretty sure you are legally obligated to respond to these surveys, but here we go. Here's the thing. You can't be unemployed if you're not looking for a job. So when I had the labor survey, they asked me, are you actually active? Now, I was employed, but one of the questions is, are you actively looking for work? And if you say no, then you don't impact the numbers anymore as an unemployed individual because you're not even looking for work. So you have to be looking for work. And then if you say, I don't have a job, then you contribute to the unemployed numbers. But the number was in January, 120,000 people stopped looking for work, which is the largest decline since 2022. So yeah, the unemployment numbers dropped. We shed a bunch of jobs that we don't want to shed. But the reason why the whole number dropped instead of going up is because 120,000 people just stopped looking. They gave up. Now, where did they go? I honestly don't know. Okay. Some of it, it's really funny. Some were blaming the weather. Now, I don't know if you've seen the weather here in Ontario for the last like 8 weeks, mid-December to like mid-February. I don't even feel like leaving the house. So maybe people said, I'm just going to stop looking until the summer when the weather's nicer. It's possible. They mentioned that. I know that's what's happening in real estate right now. Freezing cold. Nobody wants to go looking for houses. I get that. Okay. So that was one of the reasons they mentioned. So I don't really know where these 120,000 people went. But again, when we're talking about any sort of surveys or government numbers, don't take the number at face value. Dig a little deeper. Now, and I don't have the number in front of me, but Ontario unemployment is probably creeping up around over 10%, if not more. That is a combination of all those jobs that were lost that I mentioned, 54,000 private, whatever. It is mainly, and here's the punchline. The reason why there's so many jobs being lost right now is a big part of it. Tariff fears by business owners, not just small business, but all business owners. And folks, you've heard me preach this ad nauseum. We've stopped building everything. There's no homes being built. Period. End of story. So guess what? Like I said at the very beginning of the podcast, if we're not building homes, that means we have tradespeople not working, we have lawyers not working, maybe bankers not working, we have builders not built. Just think of the domino effect. So this is where you really got to dig into the numbers to understand what is happening. All right. That is job numbers January 2026. Now, there's two main regions. Let's now switch gears to market stats. There's two main regions that I work in, and that's Waterloo Region and London, Middlesex, okay, Ontario. So let me dig into Waterloo Region stats. London folks, if you don't want to know about it, just fast forward to the London part. All right. So I want to talk about stats because people are trying to sell their homes right now. Some have to, some don't have to, some are testing, whatever. But it's super important that if you go to sell your home, and you all know I work with a lot of real estate partners who are amazing. I try to give them as many tools as possible because you got to understand what the hell is going on. It's not just my neighbor sold for this, so I should sell. No, that's not how it works. you got to understand what's going on in your market before you start even listing or before you even call a realtor. Well, the realtor should give you some advice, but you got to make sure you understand the stats in your area. Let's talk about this a little bit. So, so we're talking Waterloo region, and there's some very key stats by property type. So, I'm just going to give you a couple. The one you know that I like is months of inventory. Remember, months of inventory is if we stop listing homes today, how long will it take to sell out the board? During the pandemic, when everybody was buying everything, we were like a week. If we stopped listing houses today, we'd be sold out in a week. That is insanity. We've never seen a number like that before. So, where is it right now? And let's just talk about all homes, Waterloo region, including, Cambridge, Baden, everything that's included there. We're at about, I'm just going to go over the graph, 2.5 months. All properties stop selling today. We're sold out in 2.5 months. That is technically still a seller's market. Technically, all properties. We know there ain't nothing technical about this market right now, okay? Because we got to look at trends as well. We were as high as about mid 2025. We were as high over 4 months of inventory. Technically balanced market. In this world, given the number of listings, that's a key thing. The number of listings, that's pretty much a buyer's market. Okay. And sorry, just to be clear, when I said 2.5 months of inventory, that is a seller's market. I apologize. Seller's market if I misspoke. But the 4 months, that's balanced. But again, based on numbers, that's much more of a buyer's market. But I think right now, everything's a buyer's market. Now, let's dig a little deeper on months of inventory because that's all properties, condos, single family, single detached, everything. This is where the mess is. Are you ready? So, single family homes, 2024 to 2026. Let's look at some trends. Single family homes, you're between 1.2 and currently 1.8 months of inventory. That's still a seller's market. It's still a seller's market. As long as you're priced right, it's a seller's market. Semi-detached hasn't been over 1 month of inventory in 3 years. If you had a semi-detached, it's cheaper, so more people want to buy it. Okay, so if you have a fully detached home, you're probably in fully detached or semi-detached, you're in a good spot. Now, townhouses took a bit of a kicking back during the pandemic in the sense that they went up in price really fast because it was the cheapest thing people could find. We're now, believe it or not, on a townhouse. Okay, we're almost 3.5 months of inventory, and that's been steady for a couple of years now. That's crazy. So, fully detached, semi-detached, you got a lot. You got some opportunity. Just price it right. Townhouse, a little more. Now, condos. Good God bless the condos. We are now as high as, let's just round up and say 6 months of inventory. You list a condo today, you won't sell it most likely for 6 months. Right? Estimated. That's not exactly how it works, but you know what I'm talking about. 6 months of inventory. That is a lot. So that's months of inventory. That's supply. All right. Now, number of homes. All right. This, what do I want to know? I don't want to show you average days on market. Let's talk about that. All properties, average days about 45 days. Single family homes, again, they're going to sell a little bit quicker. Where am I average? Oh, I don't have that average days. Oh, there it is. No, average sale price. No, I don't have the average days by property type, and that is okay. But one stat I wanted to explain, the number of sales. Here we go. Ready? This is where it kind of hurts a little bit. Number of sales for all properties in the whole bloody region, okay, was 268. That's it. That's all that transacted. At the height of the insanity, we were almost 1,400. Okay. Few less houses got moved. So as time, what we're noticing, we're almost getting back to the more traditional. When the spring hits, lenders usually have rate specials. We've seen a few come up already. When we see that happen, we definitely see activity increase. So spring 2025, we were back up to 682, all properties being sold. In January, 268. It Here's a number for you. You ready for this? The number of condos sold in January in the Kitchener, Waterloo, Cambridge, Waterloo region, 26. Semi-detached, 18. Yikers. Anyway, an average price, I'll just give this one to you real quick. So single-family homes are definitely still kind of the hot commodity in the Waterloo region. We're now at 862,000. It did drop a couple of percent. Average house price in Waterloo region, single-family home, 862, but all homes, okay, all property types, 136 average. Obviously, we didn't have any that really dropped a huge amount. Well, the largest amount was condos, shocker, 11.3%. So anyway, that is Waterloo region in a nutshell. Let's shift over to London St. Thomas because that is a completely different story than Waterloo region. So now Waterloo region, you go back to sleep until the end. London St. Thomas is an interesting one. Remember that St. Thomas in particular had a huge run up during COVID and a huge run down after. So there's still, I think in St. Thomas, you can definitely get a great opportunity at a house if you're okay with commute and stuff like that. So let's dig into some of their numbers and let's just talk about January only, because we know January was just a slower time and London St. Thomas presents their data a little bit differently. So new listings. Let's talk about that. New listings, 1,060. But they only sold 341. Okay. So like only 1/3 of listings are selling. And they still have active listings of 2,200. A lot of inventory. What does that also mean though? The months of inventory, January only, just January. I'll talk about year to date in a moment. Just January. 6.6 months of inventory, all properties. It's a lot. That is a lot. Now, let's break this down a little bit. Okay. I'm going to head down to, I'm just looking through their sheet here. Okay. So single family homes. Okay. Actually, the stats are pretty much right on with those. So it looks like of all those sales, the 300 and change, 250 were single family. All right. So if you got a single family home in London, St. Thomas, it's probably going to move a little bit quicker, but still 6.3 months of inventory. Yikes. Yikes. Good. If you're a buyer, hey, follow me on social media. I'm saying it's a buyer's market. Not saying run out and buy something no matter what. I'm saying if you can afford it and you're emotionally ready, buy a house. On houses, only 50 were sold or 50 moved, but new listings of 189. Okay. I'm gonna flip down to year to date on these guys because this is important to look at. All right, so no, they don't have the year to date here. Oh, you know why they don't have the year to date? Because it's January, so there isn't any year to date. The year to date is January, so that's that. So there's not much else to see there. Bottom line, London St. Thomas, telling you, if you are looking for something that is affordable, great area, nice people. I know a bunch of them. Oh, average price, by the way, has pretty much stayed the same. Pretty much. Believe it or not, it hasn't changed very much. Come down a little bit, but not a lot. People are holding on to their houses longer. Keep that in mind. They're definitely holding on to their houses longer because remember, if you bought at the height, just remember this, if you bought at the height, 5%, 10% down, 2021, 2022, if your house price dropped after the pandemic slowed down and stopped, you don't have any equity right now. You got like less equity, you got negative equity probably. So people can't sell their house if they're making the payments and it's affordable, whatever. Hey, keep making your payments. It'll come back eventually. I don't know when, but the value will come back. But those folks can't transact. They're not going anywhere. Now, if they stop paying their bills and they're forced into power of sale, yeah, hey, it's gonna go. But other than that, it's not going to go. So, okay, those are the stats. Follow me on social media. Like seriously, yeah, a shameless plug, SG Mortgage Advice, and you can keep track of all these stats as they come up. All right, that's it. We're wrapping this bad boy up. Had a lot to talk about today. So, any questions, reach out. Don't forget about that webinar that we're running. Okay, how to get your kids a home, basically, if you're older and want to get them the hell out of your basement. There is a way to do it. All right. Questions, let me know. Remember, love me, like me, follow me, desire me, all that stuff. 5-star review, please. And until next time, talk to you soon.